As an investor, one of the most common advice that you will hear is to invest in the S&P 500 index fund. It holds the strongest and biggest companies in the US. It is diversified and has a very long track record of giving good returns. But the question is it a good idea to just invest all of your money into the S&P 500 index fund and call it a day? Or is it actually risky to do so? That's why in this video, we'll be looking at the pros and cons of just investing into the S&P 500 index fund. And at the end, I will also share my thoughts on which is the best choice. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. First up, it's important to understand that when you are investing in the S&P 500 index fund, you aren't just investing in any largest 500 companies in the US, but rather you are investing in a list of 500 companies that meets a specific list of criteria to join the index. So first, you need to be a company that's based in the US. Simple enough, right? Then you also need to have a market capitalization large enough to join the index. And here's the most important part. The company must be profitable in the past 4 quarters, especially the most recent quarter. So it needs to be a company that has shown that it can consistently earn money, and not just any random meme stocks like AMC that suddenly go to the moon and boom, they appear in the S&P 500. Though that would be funny. And even after fulfilling all these criteria, the company still needs to be chosen by a committee in order to get added into the S&P 500 index. So there's still a bit of active management in it. But wait, there's more. The company also needs to maintain its performance in order to stay in the index. Otherwise, it will be kicked out and be replaced by other better performing companies. In fact, the average lifespan of a company in the S&P 500 index is found to be only around 15 to 20 years. And because this list improves consistently, you end up with an index of the top companies that are ever-changing throughout the years. For example, these are the top S&P 500 companies back in 1990. You have companies like ExxonMobil, IBM, Coca-Cola, as well as some companies that you may not even have heard of before. And fast forward to today, the S&P 500 index looks vastly different and is mostly dominated by fast-growing tech giants like Apple, Microsoft, Alphabet, and Amazon. Next, the other reason as to why the S&P 500 has been so popular is of course its strong performance. Unlike the ARK ETFs, which went to the moon for a short period and quickly crashed back down, the S&P 500 has been consistently giving good returns over the long term. Since 1957 till now, it has given an annualized return of 10.5% a year. Or, to put it into perspective, if you were to just invest $5,000 and do nothing else, you will end up with almost $4 million today. But you will also already be an old APEC or old AMA, of course. Though, if you factor in inflation, you will get a slightly lower $362,000 return. But it's still pretty impressive nonetheless. Then, what makes this even more impressive is the fact that almost 88% of the fund managers underperform the S&P 500 index over the long term. This is despite having access to the most updated information, sophisticated tools, and the best analysts in the world. So, by investing in the S&P 500 index fund, you will always be investing in the strongest 500 companies in the US. You are well diversified, and therefore everyone lives happily ever after, right? Well, not quite, because here's the thing, while the US market is the most popular and probably the best stock market in the world, there are many other markets out there, and the US markets only represents about 65% of the global market share. So if you were to just invest in the US market alone, you could be missing out on potential growth from the other 35% markets. For example, Japan, which recently hit its all-time high. Same for the India stock market as well as Taiwan stock market, all of which are doing exceptionally well. In fact, if you look at history, the US market and the international market have each taken turns to outperform each other. For example, at the end of 1980s, the international market was doing better. Then it was the US turn. Later on, it was the international market turn again. And since 2011, the US market has been outperforming all the way until now. So will the international markets outperform again? I don't know. All I know is that there's certainly a possibility that it will outperform in the future. As we are nearing the US election date, there will be a lot of volatility going ahead. That's why it's important to use one of the lowest cost brokers in Singapore to trade. And for that, you can check out Webull. For the US market, during regular and extended hours, they are just charging a low fee of 0.025% with a minimum of 50 cents. And for overnight hours, they are charging 0.03% of the total trade amount with a minimum of 89 cents. For the SGS market, commission is 0.025% of the total trade amount with a minimum of 80 cents. And the platform fees is 0.025% of the total trade amount with a minimum of SGD 80 cents. New users will get to enjoy commission-free trades for US stock trading for 1 month and commission-free trades for Singapore stock trading for 3 years. Right now, both new and existing users will also get to enjoy US options free commissions if you trade a minimum of 100 options contracts this month. For new users who use my exclusive link to sign up to Webull, if you fund your account, trade and fulfill the respective criteria, you'll be eligible to get up to $400 cash vouchers and up to 7% per annum yield for the USD money pool for up to 90 days. When you fund a cap of $100,000, potentially earning a yield of $1,750. Or if you are an existing user who has not transferred any shares into Webull before, you can also take part in the transfer in promo, where you can get up to $1,500 trading vouchers when you fulfill the requirements. So if you are interested, do sign up to Webull using my link down below. And let's get back to the video. Besides that, Vanguard is also suggesting that US stocks are unlikely to repeat their past performance over the coming decade, as international stocks might see better valuation expansion, higher dividend yield, and more favorable exchange rates in the coming years. And speaking of valuation, the S&P 500 has a PE ratio of almost 30, whereas Japan's Nikkei's 225 PE is a lot lower at 17, and China Shanghai Composite Index PE is only at 9. So by investing in the S&P 500 alone, you could be buying something that's already expensive when there could be opportunities elsewhere. Now, of course, I'm not saying that just because a market's PE is low, it will go up, yeah. Or if a market's PE is high, it will go down, yeah. It's definitely a naive way of thinking, since the PE ratio is just a representation of what investors think of the market and nothing else. Next, perhaps a bigger reason as to why going all in into the S&P 500 may not be a good idea is because of something called the lost decade. Looking back in history, there have been long periods of time where the S&P 500 basically went nowhere, like during the 1920s all the way to 1940s, from 1960s to 1980s, and the most recent one was from the early 2000s all the way to the early 2010s. So if you are super unlucky and you started investing right at the start of a lost decade, oh, you might end up with zero or even negative returns. Now, to be fair, the lost decade can still happen even if we are diversified globally. But check this out. What Provident found was that within a 10-year investment period, when the S&P 500 was in a prolonged downturn, the MSCI All Country World Index either gave lower drawdowns or even positive returns. This could be beneficial in two ways. One, by diversifying globally, even though you are getting a slightly lower return, in exchange, you have lower drawdowns as well as lower risk of getting stuck in a lost decade. 2. Having lower drawdowns also means that you will have less reasons to panic sell, which means that you'll be able to stay invested for a much longer period to reap the market's rewards. Now, even with all these reasons, personally, I have my theory on why going all in into the S&P 500 is okay. Yes, I know it sounds controversial, but hear me out. Back in the past, when we look at the biggest companies in the world, many of them derive their earnings from their home country itself. For example, some of the biggest companies in 1989 were banks from Japan, which mostly operated in Japan. Then we have Exxon Corp, General Electric, and AT&T from the US, which also operate mainly in the US. But as the years go by, due to the internet revolution and globalization, we are now living in a more interconnected world. As a result, many of the biggest companies today aren't just earning from their home country alone, but from everywhere worldwide. For example, back in 1948, foreign profits of the S&P 500 companies accounted for less than 5% of their total corporate profits. But by 2018, this has increased to almost 30%. And unsurprisingly, this percentage is even higher for many of the large tech companies. For example, Apple now earns 57% of their revenue overseas, Microsoft 50%, Google 52%, Nvidia 56%. And by the way, do you want to take a guess on which are the biggest companies in the world right now? Yup, they are your big tech companies, like your Apple, Microsoft, Nvidia, Google, Amazon, and so on. Which, by the way, many of them are from the US. So in a way, when you are investing in the S&P 500, you are already sort of investing globally. Also, one side benefit of being able to operate globally is that you will have the best engineers and the smartest scientists from all around the world wanting to work for you. And that forms a positive feedback loop where the stronger you are, the stronger you will get. Besides that, the other reason the US market is so strong now is because many of the foreign companies are now choosing to list on the US stock exchange. For example, a growing number of European companies are moving to US exchange. Same for Chinese companies, and even Singapore companies prefer to list there too. That's because the US stock market gives them access to more investors. There's better liquidity, higher visibility, and so on. And it's not as though any company can just list there just like that. Instead, they must first meet all the strict requirements in order to be accepted. And over time, we end up with the biggest and most popular and best stock market that we have now. However, with all that's been said, while investing in the S&P 500 is a good bet for the foreseeable future, the risk is that all it takes is just one or several black swan events to wipe out this advantage. For example, back in the 1600s, where the Dutch were at their peak, nobody could have foresaw that the British would overtake them in the 1700s. Likewise, nobody would have thought that the US could have come out on top in the 1900s. So it could be due to a huge war, an economic collapse, or even some countries banding together to create their own alliance, like the BRICS organization, all of which could affect the US companies. So I guess it is still prudent to diversify globally and accept lower returns in order to reduce the geopolitical risk. But how much lower returns are we talking about? To be honest, the difference in return isn't exactly that big. If we compare the annualized 10-year return of the S&P 500 ETF to the all-world ETF, the difference in return is only around 4.37%, which is a rather small price to pay in exchange for a better peace of mind, as well as a better chance of success in growing your money. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.